Pre-retirement or early financial independence, uh, that's something that many of us are working towards. But the years leading up to retirement and shortly after retirement, they truly are fragile. There's this balancing act, both personally and financially. And I mean that in the literal sense. The stakes really do compound at an increasing rate as you near retirement. So, retiring early brings a whole new set of opportunities, but it also brings a whole new set of risks. And today we're going to discuss both, all with the intention of making your dollar go a little bit further. My name is Mike MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. And today I'm joined by Valerie Escobar, who's also a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. Valerie, how we doing?
How's it going?
It's going good. It's going good.
Good.
I think a lot of people this fire movement is one that's familiar, right? Financial independence, retire early. This idea
hmm
of kind of cutting expenses, or maybe you've just accumulated enough to where it's, hey, I can achieve financial independence before maybe this general retirement date of Social Security. And there really are a different set of opportunities and risks that come with that. So the first piece that I just wanted to touch on, and Valerie, I don't know if you have had any experience with this, but um, retirement is really just a replacement of your income.
Right.
So
Yeah, no, for sure. Because I think, and that's a great way to put it, because I think clients are sometimes think, uh, now what?
yeah,
I used to get a paycheck and now what? And now we just have to phrase it where we're just getting your paycheck from a different source.
yeah, your entire adult life, you've made this income, and then suddenly really what you're doing is just replacing it by some other means. That's what retirement is. It's
hmm
just the replacement of income. And when we shut that income off, it can be slightly terrifying. But um, there's this question of, okay, well, since I'm dropping my traditional income to lower brackets, should I be taking advantage of something called a Roth conversion, which I'll cover here next? Or should I consider potentially harvesting some gains in a taxable account that I have, right? So again, because individuals are in this lower income bracket, the first opportunity I want to talk about today, as far as just, hey, what can I do if I'm retiring early, is Roth conversions. And you've maybe heard this, or maybe you're familiar with it, but really, Roth conversion is just converting some monies from your traditional IRA or a traditional 401k to a Roth IRA. And you can do any amount. Sometimes people think they have to convert the entire account, but you can do any amount in any given year. And when you do that, that money is being taxed at your income rates. So you've already paid FICA taxes on it, but the money that you would be converting would be taxed at your income rates. And if you're retiring early, theoretically, you're in a lower bracket.
hmm
And if there's one consistent theme amongst all the pre retirees that I meet, it's the fact that they are massively overweighted in traditional pre tax monies. They typically have a large IRA that's traditional, or pre tax 401k. And that presents some challenges in retirement. There are some
Right.
massive benefits to converting to a Roth IRA. And I don't know if you've experienced the same thing just working with people, but again, it's very
For
rare that I
sure.
meet someone. I don't know if I've ever met someone who has more in their Roth than traditional.
Yeah, and I mean it makes sense because if someone is in a position to be able to retire early, it means that they had a pretty good income. Either they have extremely low expenses, they figured out how to really live off of, a little bit above cat food, but usually it's more that they had a large income and so they had a big tax bill before, therefore putting money into a qualified account, 401ks, for example, would make sense that would reduce their taxes. So yeah, having
Yeah.
those big IRAs was super helpful then, but now, Uncle Sam's going to want what's his at some point. And so that's why we end up with this problem here.
Yeah. And this imbalance of sorts, right? So very few seem to understand all the benefits of Roth. So people say, yeah, you don't have to pay taxes on it as it grows. So you get tax-free growth, you get tax-free distribution. I get that. But I don't think people fully understand all the benefits of Roth monies. Okay. So I want to go through just a couple as far as why you might consider converting later years. Number one, tax diversification. So tax rates today are historically low compared to averages. I mean, they are, if you look just over the course of the US tax history, I know that's probably something most people are doing with their free time. But if you were to do that, you would find that historic rates are considerably higher than where we're at right now. So it's a benefit to have tax diversification because if tax rates go up, well, theoretically, you didn't just bank on being in a lower tax bracket later in life. That's benefit number one of why you might consider Roth conversions. The second benefit is Social Security. So this is one of those pieces where you kind of get there, you file for it, and you say, wait a second, Social Security can be taxed up to 85% of your benefit can be taxed. And Roth distributions don't actually make that benefit taxable, while traditional distributions, they will increase what's called provisional income. And
Right.
that's essentially the formula for determining whether someone's Social Security benefit is taxable. So Roth distributions don't affect that. That's another big benefit. It's kind of a thorn as well because, well, you paid this tax to get Social Security, and then you might have to pay a tax again as you start to take it. And you get there pretty quickly if you look at the income rates. It's like 25 and 32,000 of uh, income. Again, it's a provisional income formula. The next benefit is just no RMDs.
Hmm.
So you have RMDs for traditional IRAs. This is not the case for Roth IRAs. So that's a big benefit because you can just let that money sit there as long as you want, of course, while you're living, right? And the last benefit I just want to touch on is health insurance. So Part B of Medicare is actually affected by your taxable income. So it's on a grading scale based on how much money you're making. Roth distributions do not affect this. And similarly, if you're maybe retiring early and you are going to the health insurance market, this is typically one of the bigger costs that pre-retirees would have, retirees would have if they have an early retirement. Roth distributions typically won't affect that cost.
Hmm.
Whereas, if you're taking traditional distributions, that might drive up your taxable income, which makes your health insurance more expensive.
Right.
And you can check that out actually on most states' websites, their portal for health insurance. So again, those are all big benefits, Valerie. I don't think people fully recognize as to why they might want to have some Roth monies.
For sure. And I think I would also add the idea that that Roth money is the best kind of money to leave to heirs.
Yeah.
Now with the Secure Act, heirs will be forced to take out IRA money over 10 years, whereas before you
Yeah.
could stretch it out over a lifetime. Because Roth money, you still have to take it out over 10 years, but it's tax free.
Hmm.
So I mean, it's effectively saying, I'm going to gift my heirs the gift of me paying the taxes for them. Um,
Right.
some people that doesn't rub them right, they're inheriting my money. They could at least just pay the taxes. That's
They're getting
fine.
money anyways. Yeah.
So yeah, whatever you want to do, but it's just something, if that's a consideration you want to do, then by all means.
Yeah. Yeah. But again, I think people, it's very similar to a lot of things. They get a little piece of information about something, they assume that maybe they fully understand it. I don't think people fully understand or grapple the true benefits of having Roth money. So if you're retiring early, that's definitely a consideration. But as I mentioned, there's this question of, okay, should I convert monies to a Roth IRA, or should I potentially, if I have a taxable account, harvest gains? And I know you wanted to touch on that second piece.
Yeah, in that balancing act, I'll let you talk on that. But we usually think about harvesting losses in capital, in taxable accounts, which means that we're creating a effectively tax credit, quote unquote, to use against other capital gains, so you're not having to pay taxes on it. But when you're in a low tax situation that you have no other income, you actually can take a significant amount, depending on how you file, at 0% capital, long term capital gains rate. And so
Mhm.
let's say, you just retired, you have no income because you haven't started Social Security, you realize $50,000 in long-term capital gains, and you pay 0% in capital gains tax on that. So you effectively have reestablished your cost basis at a higher rate. And so even if you didn't need the money, it's a nice way that in the future that perhaps there's a big event that you need a whole bunch of big distribution from your taxable account, that you don't have to have nearly as big the tax obligation.
Mhm. Yeah, so you can, take advantage of that 0% rate
Exactly. Yep.
on capital gains, right? So there's actually a little bit of a formula to this. People tend to just, I think, fire away at it, more than they should. Sometimes financial advisors, I think, uh, are unaware of this as well, but you know, whether you should take the income and convert or the capital gains, right? So typically, if you're in the 0% income bracket, probably going to make sense to take advantage of the income uh, trade off there. So just convert up to
Mhm.
when you hit the 10 or 12% rate. Very few people are there, but if you're maybe moving some losses forward, you might be. So who knows?
Yeah.
Um,
Always the financial plan that kind of helps, because there's so many
right.
nuanced situations. And so there's really no
It,
rule.
it's it,
But yeah, agreed.
There isn't, yeah, and then from there, it may make sense to harvest the gains if you're still in the 0% bracket up to, a certain
Hmm.
amount, from a capital gain standpoint, but it switches back and forth, point being, and there's other variables, what's your Medicare B potential, premium that you're paying, Part D premium surcharges would be another thing, um, what state income tax do you have? Are you planning on moving to another state that doesn't have income taxes? Is there a net investment income tax attached to this? Are you planning on being charitable? I mean, there's a lot of different variables here, but point being, the two considerations I think of typically if there's an early retirement first is Roth conversions or harvesting any
Hmm.
gains, just getting essentially a step up, if you
Yep.
will.
Absolutely. Yeah.
Now, while you may be able to take advantage of this, um, of course, when you sell the stock, you have to put that money
Mhm.
somewhere. There's no shortage of headlines or stories that will give you advice as to where you should invest that money. But in hindsight, some of these stories and headlines and pieces of advice, they're a little better than others. The next piece, I wanted you to maybe help with this. I know that this is something you're a little bit passionate about, and you definitely like talking with your clients about. Is just activity during
Yeah, yeah.
retirement.
It seems like such a dream for this early retirement idea, but so often the people that have been able to accomplish this early retirement are the kind that are just, they are hard drivers. They are efficient with their times, and they're constantly doing something. Going from that to doing nothing doesn't work. And so retirement, a lot of the
Yeah,
conversation goes about, well, retirement is really just about changing things. It's not about stopping. It's not stopping your paycheck. It's not stopping your work. It's just that, let's just do something that's more calming, or that's more hobby based, or something like that. But just really kind of shifting with that mind, that, the way that you think about what retirement is. And sometimes, when we're talking about early retirement, that maybe you haven't quite saved enough to be full time on the beach from your age 50 to 100. But maybe that's okay. Let's just say, well, what about if I become a florist or work at a flower shop? Or, I mean, I'm talking
hmm
about myself here,
hmm
I work at a chicken farm or something. Like, what if there's just something else that's working, that I'm doing instead, that makes some kind of income? Maybe it produces or it allows for healthcare benefits, because, like we said, another really expensive thing. But having that provided by an employer could be really helpful. And so, just that idea that,
hmm
changing that what the definition is, perhaps, of a traditional retirement.
Yeah. I mean, to be clear, I don't think nobody wants to retire and do anything, and I think a lot of people like make that statement. I've had clients and just people I've talked to where they kind of like proclaim that, well, I don't want to retire because I'd be bored. I think I'm always going to be wanting to do something. It's like, I don't think anybody is like, hey, I can't wait for the day that I can just retire and wait until I die.
Ouch.
Like nobody's making that proclamation, but for some reason people love to say it as if it makes them unique. We want financial independence in retirement because it gives us control over the most valuable asset we have, and that's
Mhm.
our time. We want to retire so we can do things
Yep.
we love, right? Um, that's not doing anything for most people, at least. I haven't met that person. The next strategy would be delaying Social Security. So I mentioned there's this gap period to kind of take advantage of Roth conversions, harvesting gains. Um, when you delay Social Security, you also get a 8% step up. So not only do you increase that gap to potentially take advantage of harvesting any gains or converting more to your Roth, you also get a guaranteed 8% step up in your Social Security benefit. That's actually a benefit that's it's quite outdated. Um, it came in, I think, around the early 2000s when interest rates were a little bit better, even though they are kind of going up now. So that's a big benefit, and I think definitely something people should consider if they are retiring early is just delaying Social Security, and that's something we always run different calculators for people on to really make sure we maximize it. But I don't know about you, but I feel like Social Security catches more hate than it deserves. I understand that, yeah, if you had invested that money over a long period of time and the market maybe would have done a little bit better for you, but I mean, uh, 2/3 of our country is reliant upon it for their primary source
Yeah.
of income, right? So, yeah, I think people underestimate how big of a benefit this is, and delaying it can increase
Hmm.
that large benefit for yourself. It's another
For
strategy for
sure.
early
And just
retirement.
making sure, it's incorporated into the plan, that there is sufficient other assets because there's a lot of things that we can do in the meantime until you begin that Social Security for sure.
Yeah. And then the next strategy, of course, is it may not be exactly like a full blown strategy, but it's certainly a consideration, and that is the 4% rule. And the 4% rule is just how much are you taking as
Hmm.
income in retirement? It's really it's the formula for kind of a general rule of thumb, if you will, to determine how much income you can take off an account without exhausting that account in your retirement. And just some brief history on this. There's a few different economists that kind of came up with this rule, but it was quite a while ago. And the question is, can you still take 4% off your portfolio without a major risk of depleting your portfolio? And I think this is one that probably requires its own episode just in itself because it's rather deep and technical. But I think that the major consideration here is just, okay, well, how does this all come together? What accounts am I pulling from? When am I pulling from them? And how much am I taking? That's a huge consideration. Again, it's not something where it's just like you flip the switch, you retire, and then
Hmm.
now I plan for everything, right? I don't think anybody thinks that, but unfortunately, sometimes people find themselves in that situation. Um, Typically, again, it's okay, what percentage can I take from these accounts? And the general rule of thumb is the 4% rule. But I would be wary. And again, I think we should dive into this deeper at a later point in time of taking 4% given some of the assumptions that were put into that formula as it was built. But really, just the consideration is here is okay, well, how much am I going to be taking? What accounts am I going to be taking it from? And when am I
Agreed.
going to be taking
Agreed. I
them?
mean, the 4%,
Right.
I think the thing that I like to use it is just to like, if you are saying I've got $1 million and I want to live off of $80,000 a year, that math isn't going to work. And so the 4% rule is helpful
Yeah. I mean,
to put it in perspective and say, okay, I'm way off here. I got to
right.
relook at things. But yeah, we're not going to build a constructive financial plan that run that rule. But yes, we will have a whole episode on that one because there's a lot to.
After tax, too. Yeah, and
Right.
it's after tax too. So if you need
Hmm.
$80,000 after tax, and as I mentioned, most people are massively overweight with pre-tax money. You're
Hmm.
going to have to take more than that, right? So yeah, there's certainly some considerations there of just okay, well, how much can I take? What account should I be taking it from? So hopefully you found this helpful if you are in that fortunate circumstance where you can start considering early financial independence. Maybe you're just working towards it. But again, we wanted to give you guys some considerations here, some planning opportunities that we like to project and help people with anytime they have the opportunity to retire early. They do have that gap period before Social Security where they can start taking advantage of some different strategies. But again, some risks to be concerned with there as well. So, as always, my name is Michael MacKelvie, certified financial planner with Mariner Wealth Advisors. Thanks for joining me today, Valerie. This is Your Life Simplified. Make sure to hit that subscribe button wherever you're listening to this on Apple Podcasts, Spotify, or YouTube.
See you next time.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification. Roth IRA conversions are complex, and treatment depends on the type of IRA that is being converted to a Roth IRA. The views expressed regarding Roth conversions are for commentary purposes only and do not take into account any individual personal, financial, or tax considerations. It is not intended to be a solicitation to buy or sell or engage in any particular investment strategy. Before initiating a Roth IRA conversion, please consult with a financial or tax professional and ensure you consider all your available options, including applicable taxes, fees, and features. A distribution from a Roth IRA is tax-free and penalty-free, providing the 5-year aging requirement has been satisfied and one of the following conditions is met: age 59 and a half, disability, qualified first-time home purchase, or death.